The longly anticipated recessions caused by markedly tighter monetary policy materialised at the end of 2023, with the UK being one of a number of countries around the world to officially record a technical recession, although some pundits may deem it a mere rounding error. The US economy, on the other hand, continued to defy the odds, in spite of higher interest rates growing at nearly 3% on an annualised rate to the end of Q1. Off the back of this, global growth is expected to be positive for 2024. Related to this was the continued reduction in inflation across the US, UK and wider Eurozone, with all regions closing in on official targets. Off the back of this, markets are now pricing in rate cuts beginning in June. However, the expectations for how many there will be has been dampened over Q1, starting with 6 rate cuts at the close of 2023 to now just 2 in the US for 2024. The economic backdrop should be positive for the near-term prospect for both equity and fixed income markets. However, any number of geopolitical or economic shocks could cause inflation to bounce back in short order. We therefore believe it continues to be appropriate to maintain suitable, diversified portfolios. Global bond markets pulled back in early 2024 following the strong close to 2023. Where they perhaps got a little ahead of themselves and following sustained economic resilience that therefore reduced the need for more immediate interest rate cuts. However, a better March led to broadly flat returns for most bond markets over the quarter. Bond yields remain the most appealing they have been for some time, however. But they are not without risks, as any upward movement in inflation expectations, continued strong economic outlooks, or even strong employment figures could lead to bond price declines, as it would signal a delay in rate cuts. Stock markets continued to rise in 2024, with the US leading the pack mainly due to the dominance of the large tech companies known as the Magnificent Seven, which include firms like Nvidia and Microsoft, who continued to enjoy significant rallies. Whilst we feel that the valuations on the Magnificent Seven stocks are high, and there may be some bubble risk building, we are comforted that many of these stocks are profitable and do continue to generate strong earnings. The prospect of rate cuts was positive for developed equity markets globally, as investors anticipated more favourable economic conditions. Despite previous poor performance, there were some signs of life in China and Korea towards the end of the quarter, which was partly attributed to the potential policy support from China and signs of easing deflationary pressures. We remain committed to maintaining a balanced stance in your portfolios, ensuring exposure to quality assets in both bonds and equities. Furthermore, where appropriate, we continue to hold positions in alternative strategies chosen to diversify with limited correlation to the traditional stock and bond markets. Within fixed income, we maintain a reasonable level of sensitivity to interest rates, which, if interest rates are cut to defend against deflation or recession, for example, should be a positive contributor to bond market returns. Considering the risks associated with the potential economic downturns and the high valuation levels in the US, we maintain our stance that interest rates have likely reached their peak. While valuations in other regions appear more favourable, we therefore maintain a neutral level of exposure to equities across the portfolios.